Something unusual is happening beneath the surface of the global economy. Gold is not simply rising, it is leading. While equities debate direction, while bond markets argue about rates, gold is quietly asserting control over the monetary conversation. And when gold begins to dominate, history suggests something deeper is shifting. Not panic, not hype. A structural transition. The question is not whether gold is strong. The real question is what that dominance is signaling, because when gold moves first, silver rarely stays silent forever. But timing is everything, and 2026 may not unfold the way most investors expect. Welcome to John Analyst. If you value calm, serious economic briefings over noise and speculation, consider subscribing. Think of it as securing a front row seat to clarity, and at this stage in life, clarity is worth more than excitement. And before we begin, tell us where you are watching from, which city, which country, because economic shifts never move in isolation, they move through real places and real people. Gold is not merely rising, it is leading. And in capital markets, leadership matters more than momentum. When equities rally, it can mean optimism. When bonds rally, it can mean caution. But when gold dominates both at the same time, it often signals something structural beneath the surface of the financial system. The current cycle is unusual, not because gold is strong, but because of who is buying it. For decades, central banks reduced gold exposure while increasing holdings of sovereign debt, particularly U.S. Treasuries. That shift symbolized confidence in the global financial architecture. Dollar liquidity was abundant. Inflation appeared contained. Gold became secondary. That era is fading. Over the last several years, official sector gold accumulation has accelerated meaningfully. Central banks, particularly in emerging economies, have increased allocations at levels not seen in decades. This is not speculative behavior, it is strategic balance sheet restructuring. When sovereign institutions diversify reserves into hard assets, it signals a recalibration of trust. Not necessarily in the dollar's function, but in its long-term stability. Currencies rarely collapse overnight in developed economies. What changes first is confidence at the margins, and gold thrives in marginal shifts. Gold does not require hyperinflation to perform. It performs when policy credibility becomes uncertain, when debt trajectories appear politically untouchable, when structural deficits persist without visible correction mechanisms. The post-pandemic era has introduced precisely those conditions. Advanced economies expanded fiscal deficits to historic levels. Public debt ratios rose sharply. Central bank balance sheets expanded in response to crisis stabilization. While inflation has moderated from peak levels, the structural debt overhang remains. Investors are not blind to this. Real yields, arguably gold's most important macro variable, have been volatile. At times, rising real yields pressured gold lower. Yet gold's resilience during those episodes has been notable. It has not collapsed. It has consolidated and then resumed strength. That resilience reveals something deeper. Gold is increasingly behaving as institutional insurance. Insurance is rarely dramatic. It is deliberate. Institutions allocate to gold not for short-term profit, but for long-term balance. Sovereign buyers understand that reserve assets must serve a stabilizing role when geopolitical risk, trade fragmentation, and monetary divergence intensify. Fragmentation is accelerating. Trade relationships are becoming more regional. Strategic resource nationalism is expanding. Sanctions have demonstrated that reserve assets can be politically constrained. In such an environment, neutral collateral regains appeal. Gold carries no counterparty risk. It is not dependent on clearing systems. It cannot be frozen by foreign governments. For central banks navigating a more multipolar world, that neutrality is strategic. Meanwhile, domestic investors face a slower but persistent concern: purchasing power erosion over time. Inflation does not need to spiral for gold to remain relevant. Even steady annual erosion compounds significantly over a decade. When fiscal expansion appears persistent and entitlement obligations grow, long-term currency dilution becomes a gradual certainty rather than a sudden shock. Gold absorbs that anxiety. Markets often anticipate monetary easing before official confirmation. Gold frequently advances months ahead of confirmed rate cuts. It responds to expectations, not announcements. If investors expect policy accommodation, even gradual accommodation, gold adjusts early. It does not wait for press conferences. It responds to forward-looking signals embedded in bond markets and fiscal projections. In this cycle, gold's dominance is not occurring in isolation. It is outperforming in an environment where risk assets remain resilient and real yields fluctuate. That divergence suggests the move is not purely fear-driven. It is strategic repositioning. Institutional allocators are not abandoning growth. They are diversifying at the margin. And when diversification becomes consistent rather than episodic, it creates sustained demand floors. Gold is benefiting from that floor. Importantly, gold's dominance does not guarantee crisis. It does not predict collapse. What it indicates is recalibration. Capital is pricing policy uncertainty. geopolitical fragmentation, and structural debt expansion into portfolio construction. Gold is often the first asset to reflect that recalibration. And when gold asserts dominance during transitional periods, other assets eventually respond. The question is not whether gold deserves attention. The question is what its leadership implies for the rest of the monetary metals complex. Because when gold moves first in a regime shift, it rarely moves alone forever. If gold is the signal, silver is the amplifier. But amplification works in both directions. Silver does not move with the calm authority of gold. It does not represent the same clarity of purpose. It occupies a more complicated position within the global economy, half monetary asset, half industrial input. And that dual identity is precisely what makes it powerful and dangerous. For decades, silver has been described casually as poor man's gold. Now, that description is not only inaccurate, it is strategically misleading. Gold functions primarily as a monetary reserve asset. Its demand is driven by central banks, institutional hedging, and macro uncertainty. Silver, by contrast, must respond to two separate forces simultaneously: monetary conditions and industrial consumption. And when both forces align, silver can outperform dramatically. When they diverge, silver becomes unstable. The business community must understand this structural tension before drawing conclusions about 2026. Silver's industrial footprint has expanded meaningfully over the last decade. Electrification trends, renewable energy installations, semiconductor manufacturing, battery storage, advanced medical equipment, and power infrastructure upgrades all rely on silver's conductivity and reliability. Unlike gold, silver is consumed. It is embedded in solar panels dispersed across circuits, integrated into manufacturing systems. Much of it becomes uneconomical to recover once deployed. That consumption dynamic differentiates it fundamentally from gold, which is largely stored rather than destroyed. In recent years, solar capacity additions alone have increased materially. Grid modernization projects continue. Data center construction tied to artificial intelligence expansion demands upgraded electrical systems. Semiconductor fabrication plants require precision inputs. Each of these sectors draws incrementally on silver supply, yet silver production does not operate independently. A significant portion of global silver output is derived as a byproduct of copper, lead, and zinc mining. This creates structural inertia in supply. Silver cannot be scaled rapidly in response to price signals alone because primary miners are not always silver-focused operators. If copper investment slows, silver supply may tighten, even if silver prices are rising. That rigidity matters in a tightening demand environment. However, the narrative of supply deficits requires careful interpretation. A deficit in annual flow, where demand exceeds new mine supply, does not necessarily indicate imminent exhaustion of above-ground stocks. Inventories exist. Recycling adjusts. Substitution occurs at higher prices. Markets ration demand when necessary. The term deficit should not be interpreted as shortage tomorrow. But persistent deficits over multiple years do increase sensitivity to shocks. They reduce buffer capacity. They raise the probability that unexpected demand surges or geopolitical disruptions could create temporary price dislocations. Silver, therefore, becomes more reactive than gold during periods of supply strain. And reactivity translates into volatility. Historically, silver's price swings have exceeded gold's in both upward and downward cycles. During risk-on expansions, silver often outpaces gold percentage-wise. During recessions or liquidity squeezes, it can decline more aggressively due to its industrial exposure. That volatility is not an anomaly. It is embedded in its dual-purpose identity. For capital managers, volatility is not merely emotional discomfort. It represents allocation risk. Position sizing must account for it. Liquidity management must anticipate spread expansion. Physical markets and paper markets do not always behave identically during stress. Silver's spreads can widen significantly in periods of uncertainty. Premiums may spike or compress depending on inventory and dealer positioning. Conversion from metal to cash is slower and more friction-heavy compared to digital securities. These are operational realities, not theoretical considerations. Another overlooked dimension is capital expenditure cyclicality. Industrial demand growth does not move in straight lines. Solar installations can surge during favorable subsidy regimes and pause when financing tightens. Semiconductor expansion can accelerate during chip shortages and slow during inventory corrections. Electric vehicle adoption can fluctuate with policy changes and consumer demand cycles. Silver demand tied to these sectors inherits their variability. Therefore, projecting a simple linear demand curve into 2026 is strategically naive. However, dismissing industrial acceleration would be equally short-sighted. The world is undergoing structural electrification. Power grids require reinforcement. Data infrastructure expansion is unlikely to reverse. Manufacturing reshoring initiatives in various countries introduce additional metal intensity into domestic production cycles. These are long-duration themes. Silver stands at the intersection of these transitions, but intersection is not dominance. Unlike gold, silver does not receive systematic central bank accumulation at scale. It lacks the same reserve status clarity. Its monetary demand is more retail-driven and sentiment-sensitive. This makes silver more prone to narrative-driven surges and equally prone to narrative exhaustion. For entrepreneurs and capital allocators, the lesson is precise. Silver must be categorized properly within a portfolio. Is it held as macro insurance? Is it held as industrial growth exposure? Is it held as a volatility trade, anticipating liquidity expansion? Each objective demands a different risk framework. Confusion between those roles creates strategic mistakes. Silver's dual identity is neither flaw nor guarantee. It is leverage, structural leverage to macro conditions and industrial expansion simultaneously. When gold leads, due to monetary uncertainty, silver waits for confirmation. If liquidity improves, while industrial build-out continues, silver can accelerate sharply. If industrial growth slows, while monetary policy remains restrictive, silver can stagnate, even if gold remains resilient. Understanding this divergence is critical. Silver does not merely follow gold, it reacts to an additional layer of economic complexity. And as 2026 approaches, that complexity will determine whether silver becomes a beneficiary of gold's dominance or a volatile bystander awaiting clearer signals. Every cycle produces a year that investors circle in red ink, a year that appears to hold answers. For many in the business community, 2026 is beginning to look like that year. A potential leadership transition at the central bank, an election cycle, lingering fiscal expansion, industrial capital expenditure commitments already in motion. The variables are converging. But convergence does not guarantee outcome. It guarantees complexity. The first pillar of the 2026 thesis centers on monetary leadership. Central bank chair transitions historically create speculation about policy direction. Markets tend to assume that new leadership implies a pivot, often toward accommodation. That assumption is strategically dangerous. Monetary policy does not change because personalities change. It changes because data forces adjustment. A new chair inherits structural conditions, debt levels, inflation expectations, labor market resilience, and global currency pressures. Even if rates decline in 2026, the reason for the decline will determine market reaction. If cuts occur because inflation cools organically while growth remains intact, financial conditions may ease gradually. Risk assets could absorb liquidity more quickly than metals. Gold may remain supported, but silver's acceleration would depend heavily on industrial momentum. If cuts occur because growth weakens sharply, liquidity preference rises initially. In early phases of economic stress, investors often sell what is liquid, not what is ideal. Silver, with its higher volatility, can be caught in that first wave. Only after stabilization does it typically recover strength. Then there is the third possibility, policy paralysis. Inflation stabilizes above target, but growth slows just enough to prevent aggressive tightening. In this environment, real yields fluctuate without clear direction. Liquidity becomes inconsistent. Markets oscillate between optimism and caution. That is not cinematic, but it is plausible. For business leaders, the distinction between these paths is critical. Silver's performance in 2026 will not be determined by headlines alone. It will be shaped by which macro path unfolds. Election cycles complicate the equation. Political incentives favor economic stability. Fiscal policy often becomes more accommodative near electoral transitions. Infrastructure commitments, defense spending, and industrial subsidies may expand in response to domestic priorities. Yet fiscal stimulus does not always translate into inflationary surge. It can offset private sector slowdown rather than ignite new growth. The scale, timing, and funding method matter. Meanwhile, global fragmentation introduces additional uncertainty. Trade realignment efforts continue. Supply chain resilience strategies persist. Strategic materials. Classification, such as critical mineral designations, may influence long-term investment flows. But designation alone does not equal immediate government purchasing. It signals awareness. Markets frequently misinterpret awareness as action. In reality, strategic stockpiling requires budgets, legislative coordination, and procurement mechanisms. The process is incremental, not instantaneous. The more subtle effect lies in private capital behavior. When a material receives official strategic recognition, investors reassess long-term viability. Financing conditions for related projects may improve. Exploration incentives may rise. Industrial planning may adjust. These secondary effects unfold over years, not months. Thus, 2026 should not be viewed as a single event year. It is a node within a longer transition. Liquidity timing also requires discipline. Markets price expectations well before policy implementation. If investors widely anticipate easing, metals may appreciate before official rate adjustments occur. By the time cuts are announced, positioning may already be crowded. Crowded positioning increases volatility. Entrepreneurs and capital managers must ask a different question. Is 2026 an opportunity or a psychological anchor? When a year becomes widely labeled as pivotal, expectations accumulate. High expectations elevate risk. If reality underperforms narrative, prices adjust quickly. That adjustment can be misinterpreted as thesis failure. Yet it may simply reflect premature enthusiasm. From a structural perspective, 2026 does contain legitimate convergence elements: monetary recalibration potential, fiscal cycle sensitivity, industrial expansion commitments tied to electrification and data infrastructure, supply inertia within mining sectors. However, none of these variables operate in isolation. Soft landing conditions could favor gradual appreciation across metals without explosive upside. Hard landing conditions could produce volatility before recovery. Persistent inflation without growth could sustain defensive positioning in gold, while silver waits for industrial clarity. Strategic planning requires acknowledging all three paths simultaneously. For the business community, the correct posture is not prediction, it is preparation. Allocation frameworks must define maximum exposure before volatility intensifies. Liquidity reserves must remain intact. Exposure to metals must align with balance sheet capacity, not emotional conviction. Silver, in particular, will respond more aggressively to macro convergence than gold. Its dual identity magnifies policy shifts. If liquidity expands while industrial investment continues, silver may compress the performance gap rapidly. If liquidity disappoints or industrial demand falters, silver may lag despite gold's resilience. Therefore, 2026 is neither destiny nor illusion. It is a convergence year with multiple possible trajectories. Those who approach it with rigid expectations risk disappointment. Those who approach it with structured flexibility maintain advantage. And as gold continues to assert dominance entering this convergence phase, the question is not whether silver will react. The question is under which macro path its reaction becomes sustainable. When gold dominates headlines, attention eventually turns to the ratio. The gold-silver ratio has long been treated as a predictive shortcut. When it stretches higher, silver is labeled cheap. When it compresses, silver is declared in motion. The logic appears simple, but simplicity can be deceptive. The ratio is not a clock. It does not ring a bell announcing silver's inevitable surge. It is a relative value indicator, a compass, not a countdown timer. Historically, the ratio has expanded during periods of acute uncertainty. In crisis environments, capital prioritizes liquidity and monetary purity. Gold benefits first. Silver, with its industrial exposure, hesitates. The ratio widens. During synchronized growth phases, when liquidity improves and industrial demand accelerates simultaneously, silver often outperforms. The ratio compresses. Yet history also shows that ratios can remain elevated far longer than expected. Structural shifts in manufacturing, investment flows, and monetary policy can sustain imbalances for years. Treating the ratio as gravity, assuming it must revert on a predetermined schedule, invites premature positioning. For strategic capital allocators, the ratio is better used as a weighting guide. When the ratio reaches historically high levels, it may justify gradual tilting towards silver within a defined allocation band. When it compresses meaningfully, it may warrant rebalancing back toward gold. Notice the emphasis: gradual, defined, disciplined. Not all in switches. Silver's volatility amplifies timing errors. Overweighting prematurely in anticipation of compression can expose portfolios to extended stagnation or drawdowns if industrial conditions weaken or liquidity tightens unexpectedly. Furthermore, the ratio does not operate independently of macro context. If gold's dominance is driven by geopolitical fragmentation and reserve diversification, silver may lag until industrial clarity improves. If gold leads because of anticipated liquidity expansion, silver may accelerate once easing becomes visible. Understanding the cause of gold's strength is essential before extrapolating silver's potential. Another complexity lies in market structure. The paper market, futures and exchange-traded products, reacts faster than the physical market. Ratio compression in paper pricing does not always translate immediately into physical availability or premium shifts. Physical spreads can widen during volatility, creating friction for real-world transactions. Entrepreneurs and business owners who consider holding physical metal must account for operational factors: storage costs, insurance, bid-ask spreads, and liquidity timing. Unlike digital securities, physical conversion to cash is not instantaneous. Silver, being bulkier and heavier relative to value than gold, introduces logistical considerations. As wealth scales, storage efficiency becomes increasingly relevant. This introduces an often overlooked life cycle dimension. Younger investors with higher volatility tolerance may accept silver's amplified swings in exchange for upside potential during compression phases. More mature allocators may prioritize gold's stability and portability. Neither approach is inherently superior. They reflect differing risk capacities and liquidity needs. The ratio can inform those decisions, but it cannot replace them. There's also the psychological element. When the ratio remains elevated for extended periods, frustration accumulates among silver advocates. This frustration often fuels aggressive forecasts and dramatic price targets. Conversely, when compression begins, enthusiasm can escalate rapidly, encouraging late-stage overexposure. Markets frequently punish emotional acceleration. A disciplined framework counters this risk. First, define maximum total exposure to monetary metals within overall portfolio construction. This boundary prevents narrative escalation from overriding capital preservation. Second, establish predetermined tilt ranges based on ratio levels, not to predict timing, but to systematize allocation shifts. Third, separate insurance holdings from opportunistic positions. Insurance holdings remain stable through volatility. Opportunistic positions may adjust based on macro developments and ratio behavior. Fourth, define pause conditions. Under what macro signals would additional accumulation cease? Real yield spikes, industrial contraction data, liquidity tightening. Writing these conditions in advance transforms uncertainty into strategy. In 2026, the ratio will not operate in isolation. It will reflect interactions between monetary recalibration, industrial demand momentum, and supply responsiveness. If liquidity improves gradually and industrial expansion persists, compression becomes plausible. If liquidity disappoints or growth slows meaningfully, elevated ratio levels may persist longer than anticipated. Therefore, the ratio should be viewed as diagnostic. It diagnoses relative tension between monetary demand and industrial demand. It does not prescribe exact entry or exit moments. For serious decision makers, this distinction matters profoundly. Gold's dominance entering 2026 establishes the backdrop. Silver's response depends on whether macro conditions evolve from defensive positioning towards synchronized expansion. The ratio will adjust accordingly, but it will do so on the market's timeline, not on investor impatience. In strategic allocation, impatience is expensive. The ratio is a map, not a stopwatch. And those who interpret it correctly gain orientation without surrendering discipline. Because when gold leads in a structural transition, silver may follow, but only when the broader economic terrain allows it. Understanding that terrain, rather than chasing ratio extremes, separates disciplined capital management from speculative impulse.